Today we're diving into one of the most confusing and fascinating questions about the global economy. If every country in the world is in debt, then who exactly do they owe all this money to? It's a question that seems simple at first glance, but once you start pulling on the threads, you realize it opens up an entire web of financial systems, global politics, and money that only exists as numbers on screens. So, sit back as we unpack this mystery and figure out who the real creditor of the world actually is. When we hear that the United States has trillions of dollars in debt, or that Japan's debt-to-GDP ratio is over 200%, it's easy to imagine that there must be some mysterious, rich figure or organization that all these countries owe money to. But the truth is much more complex and honestly a bit strange. Most of the world's debt doesn't come from a single person or country. In fact, much of it is owed internally, meaning governments owe money to their own citizens, institutions, and even other parts of their own government. Let's start with what national debt really is. When a government spends more money than it collects in taxes, it borrows the difference by issuing bonds. These bonds are essentially IOU. They say, we'll pay you back later with interest. People, banks, pension funds, and even other governments can buy these bonds. So, when you hear that the U.S. or any other country has a massive national debt, part of that debt is actually money that citizens or domestic institutions have lent to their own government. In the United States, for example, roughly 2/3 of the national debt is held domestically. That means the U.S. owes most of its debt to Americans, not to foreign countries, the biggest single creditor to the U.S. Government is the Social Security Trust Fund, which holds government bonds to fund future retirement benefits. Other big holders are the Federal Reserve, insurance companies, mutual funds, and regular citizens who invest in treasury bonds. Now, foreign countries do hold a significant share of U.S. debt as well, but it's not nearly as much as people think. Nations like Japan and China are among the top foreign holders, but they invest in U.S. Treasury bonds mainly because the U.S. dollar is considered one of the safest currencies in the world. Holding U.S. debt gives them a stable place to park their money and helps them manage their own currencies in global trade. So, if most countries owe money to themselves, does that mean it's not a problem? Not exactly. Debt can still be dangerous if it grows too fast, or if investors lose confidence in a country's ability to pay it back. But it's important to understand that debt in the modern economy isn't like personal debt. When you borrow money to buy a car or a house, you eventually have to pay it back. But a government can continually roll over its debt by issuing new bonds to replace old ones. In theory, this process can continue indefinitely as long as the economy grows and people trust the government's financial system. Now, what about other countries? Take Japan, for instance. Japan has the highest debt-to-GDP ratio in the developed world, but almost all of its debt is held domestically. Japanese citizens, banks, and institutions hold Japanese government bonds, which means Japan owes money mostly to itself. That's why, despite having a huge amount of debt on paper, Japan hasn't experienced the kind of financial collapse you might expect. Then there are countries that owe more to foreign creditors. For many developing nations, a significant portion of their debt is held by foreign governments, international organizations, or global investors. For example, countries in Africa, Latin America, and parts of Asia often borrow money from the International Monetary Fund, the World Bank, or through the sale of bonds purchased by investors in wealthier nations. This can create a much riskier situation because these debts must be repaid in foreign currencies, often the U.S. dollar, which makes them vulnerable to exchange rate changes and global market shocks. So, if you step back and look at the global picture, it seems like the whole world owes money to the whole world. Each country borrows from its own citizens, from foreign investors, and from international institutions. But here's where it gets interesting. If you add up all the world's debts, you might think there must be someone, somewhere, sitting on the other side of that equation, being owed all this money. The answer is both simple and strange. The creditor is, collectively, us, the global population of investors, banks, companies, pension funds, and governments. In other words, the money that one country owes is often someone else's investment. A pension fund in Germany might hold U.S. treasury bonds. A bank in China might hold debt from African countries. An insurance company in Canada might invest in bonds issued by the U.K. government. The global financial system is deeply interconnected, and in this web, debt isn't just a sign of weakness, it's also a mechanism that keeps money flowing and economies running. But what about the institutions like the IMF and World Bank that we hear about so often in discussions of global debt? These organizations lend money to countries that are struggling financially, often in exchange for implementing certain economic reforms. The money they lend comes from member countries, meaning that, again, it's other governments that are ultimately providing the funds. When a developing country borrows from the IMF, it's really borrowing from a pool of money contributed by dozens of nations. And then there's private debt, another massive part of the equation. Private corporations borrow money by issuing corporate bonds, taking out loans, or using credit to expand their businesses. Banks also create money in the process of lending, meaning that a large portion of global debt literally comes from money that didn't exist before it was borrowed. When banks give out loans, they're creating new money that adds to the overall supply in the economy. This is why the global financial system can have more debt than there is physical money in existence. So, if every country, business, and person seems to owe someone else, and that money is mostly created out of thin air by the banking system, what's keeping it all from collapsing? The answer lies in confidence. The entire system depends on trust that governments will honor their bonds, trust that banks will stay solvent, and trust that economies will continue to grow. As long as people believe the system works, it does. But once that trust breaks, things can unravel quickly. We've seen this before in history. The 2008 financial crisis was essentially a crisis of confidence. Banks had taken on too much risky debt, and when investors realized that many of those debts couldn't be repaid, panic set in. The same thing can happen to countries. When investors lose faith in a government's ability to repay its debt, they demand higher interest rates or stop lending altogether, which can lead to economic collapse like what happened in Greece during the European debt crisis. But not all debt is bad. In fact, debt is one of the key drivers of modern economic growth. It allows governments to invest in infrastructure, healthcare, and education. It allows businesses to expand and hire more workers. It allows consumers to buy homes, cars, and goods, which keeps the economy moving. The problem only arises when debt grows faster than the economy's ability to support it, or when it's used unproductively. So, back to our big question, if every country is in debt, who's the creditor? The answer is a mix of governments, financial institutions, investors, and you. Every time you invest in a bond, hold a retirement account, or even keep your money in a bank, you're indirectly lending it to someone else, maybe even a foreign government. The global debt system is really a massive network of values circulating through banks, corporations, and individuals. It's less about who owes who and more about how that flow of debt keeps the world economy running. But let's take it even further. What if we added up all the global debt and compared it to all the money in existence? As of recent years, global debt exceeds $300 trillion, while the total amount of physical cash and money supply is far less than that. How can the world owe more money than exists? It's because most money is not physical. It exists only as digital entries in computers. Debt creates money, and money fuels debt. The two are interdependent. Without debt, there would actually be far less money in circulation. It's a strange reality in the modern financial system. Debt isn't just a burden, it's also a form of wealth. When you hold a government bond, that debt is your asset. So, one person's debt is another person's wealth. That's why, on a global scale, total debt and total wealth are always linked. When countries or corporations borrow, they're creating assets for lenders. The balance sheets of the world always have both sides. Now, some people argue that this system is unsustainable, that someday, the entire house of cards could come crashing down. And while that's a scary thought, it's important to remember that the system has evolved over centuries and continues to adapt. Governments can manage debt through inflation, taxation, and monetary policy. Central banks play a crucial role here by controlling interest rates and influencing how easy or hard it is to borrow money. When they lower interest rates, borrowing becomes cheaper and debt grows. When they raise rates, the opposite happens. Inflation is another key factor. When prices rise over time, the real value of existing debt decreases, making it easier for borrowers to pay off what they owe. That's one reason governments don't necessarily mind moderate inflation. It helps erode the burden of debt. But too much inflation, and confidence in the currency starts to fall apart. Too little, and economies can stagnate. Some people even suggest that in the end, no one will ever truly repay all the debt, and that's okay, because the system isn't designed for all debts to be paid off at once. It's designed for constant movement, for money to circulate, for credit to flow, and for economies to keep expanding. The global debt system is less like a loan that must be settled and more like a continuous machine that relies on trust and momentum. There's also an ethical side to this question. When developing countries borrow heavily from richer nations or international institutions, it can trap them in cycles of repayment that limit their ability to invest in their own people. This is sometimes called the debt trap, and it has sparked major debates about fairness and responsibility in global finance. Critics argue that some of this debt should be forgiven or restructured, especially when it was taken under corrupt or exploitative conditions. On the flip side, countries with strong credit reputations can borrow almost endlessly at low interest rates. The United States, for example, benefits enormously from the dollar's status as the world's reserve currency. This means other countries want to hold dollars and dollar-denominated debt, allowing the U.S. to borrow more cheaply than almost anyone else. It's a position of incredible power, and it's one of the reasons the global economy still revolves around the U.S. financial system. But what happens if confidence in the dollar fades? If investors start believing that the U.S. can't manage its debt, they might turn to other currencies or assets like gold, digital currencies, or even new international financial systems. That shift could change the balance of global power in ways we can only imagine. In the end, the question, who is the world's creditor, doesn't have a single answer. It's all of us, governments, corporations, investors, and citizens, lending and borrowing from each other in a complex network of trust. The global economy is a web of interconnected promises, and as long as those promises hold, the system functions. So, the next time you hear that a country is deep in debt, remember that the world's financial system isn't about winners and losers, or debtors and creditors. It's about a continuous exchange. One country's liability is another's asset. One person's loan is another's investment, and together, all those debts and credits form the invisible structure that keeps modern civilization running. It's not a perfect system, but it's the one that fuels progress, growth, and innovation. Debt is both the world's biggest problem and its most powerful tool. The key is balance, making sure that borrowing leads to creation, not collapse. Because in the end, debt isn't just money we owe, it's a reflection of the trust and interconnection that bind the entire global economy together. And that's the real answer to who the world's creditor is. It's everyone. It's you, it's me, it's every investor, bank, and government participating in the massive, intricate dance of global finance. A system built on belief, sustained by trust, and constantly evolving one IOU at a time.